People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Welcome back to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, as always, zinniawealth.com, ZINNIA wealth.com. If it's time to talk about your retirement, let's get that conversation going. Don't delay it anymore. You're thinking about taxes right now because we're moving toward tax season. Well, let's have a retirement conversation as well. Let's look further down the line and see if we can get things lined up for you. 833-368-3680 or zinniawealth.com. All right, so I think most of us know what it is to diversify our money. You put your money in different places so when some goes down, some goes up. That's the whole idea there. Well, this week, Jamie Dimon, who we've heard from before, he's the CEO of JP Morgan. He says that we should have a diversification thought where we have money in the stock market and money outside the stock market. So, Charisse, define that for me. Tell me what those things are. I know if I'm in the market, it's stocks and bonds and mutual funds and things like that. But when we talk about outside the market, is that like CDs and money markets? And what are we talking about here?
So knowing Jamie Dimon, he's probably talking about REITs, structured notes, possibly the growth annuities, not the income type of annuities, probably some private equity and some other deals that are going on. So being just very diversified, we added some of that out of the stock market stuff to our portfolios, like the structured notes and some of those things, some of the growth annuities. There's probably 3 of them that we like across the country. CDs too, money markets, as long as they're making money, right? So the key is those things are making money. And this is why we truly believe in a diversified portfolio, not a 60-40 portfolio. So Jamie Dimon is basically saying, without saying it, don't have just a 60-40 portfolio, basically in a nutshell, because he knows he has balance sheets, he has bills to pay. If he had everything in the stock market, it doesn't matter how good their hedge fund managers are, they're losing, and they need to continue to pay their light bill, right? Pay their employees, and making sure that they're diversified on all levels, because all investments actually make a different rate of return. So they're okay with making 3 or 4% on some of their money. They're okay making 5 to 7%. They're ecstatic about making 30 to 50% on their money and doubling it, but they know that that's the long goal, and those are harder numbers to reach. And in the short run, we all got bills to pay. We all got, kids' mouths to feed and retirement travel tickets to pay for. So being diversified so that you can always do those things, like we say, pay the light bill, pay the gas bill, the grocery bill, even when the stock market's all up and down. And when we're talking about when the market's down, like it is now, what are we actually living on? Do we ruin our entire livelihood of understanding financial conventional wisdom and say, hey, well, I need my $5,000 check this month, but my accounts went down 10%. Do we pull money out of the account? And I would say no. Where are you pulling your income checks from? Are you bobbing and weaving when that happens? Do you have some of that safe money built in where you're actually pulling your money from that already? That would be hopefully 100% yes answer. And if you're not, that's when you really have to start thinking like, am I with the right advisor? Do I even know where my income's coming from? Is it coming from the stock market, or is it coming from cash, or where is it coming from? And we had somebody come in and they said, we pull like $8,000 a month from our accounts. I'm like, okay. And you're pulling it out of this account, the 60-40 portfolio? I said, yes. I'm like, that there's no cash in there, and they're having to sell that every month as the market's going down. They're like, oh, really? They're like, oh, I noticed they put cash in there. I was like, but what if the stock market goes down for 10 to 12 months? Or let's say it goes down for 6 months and it takes 8 months to get back to even. they're still having to sell at a loss. And financial conventional wisdom says never sell at a loss. Yet we have a forced hand to cover the gap to pay our bills as we're in retirement. So I say that so you guys are all listening very loudly. Where are your income checks coming from right now when the stock market is going down, right? And is there a strategy? And is it diversified? If some of the money is coming from the stock market and then a big chunk of it's coming from something else, I could be okay with that. But we definitely need to have a conversation, because this is why you want a well-oiled plan that you understand. You know what income checks are stepping in and or stepping out at different phases of the stock market volatility and or your life.
So if you sit down with a couple and Mr. walks in and his chest is all out and he's feeling pretty good about himself and he's saying, Sharice, I am diversified. I have 10 stocks and I have 10 mutual funds and I'm very diversified. And you have to look at him and smile and say, guess what? You're really not, because all of that you just mentioned is in the stock market, right? I mean, we talk about there's different places to put your money, but there's not that many. I mean, there's the stock market, there's banks, there's real estate, and there's the insurance companies. I mean, those are kind of the categories right there, the pillars, really. And interesting that the risk that goes along with the market is much more than banks, real estate, and insurance. And I think those are the things that people don't know to explore, because, Sharice, all we know is stocks and bonds when we sit down with you, and that's what we expect out of you. But what you also give us is we need to have more than that in order to plan a retirement.
Yeah, you do. And because you said mutual funds, that's a big no-no in my office too.
Oh, that's right. You're all ETFs now, right?
ETF, index funds. We haven't been doing mutual funds forever, but I'll say 8 out of 10 people who walk into my office, you are heavy in mutual funds, and I got a better plan for you that I learned. It's not a secret, but your advisors want to keep it a secret.
I think when we talk about retirement, I think one of the things that we should probably say is retirement is spreading out risk. Honestly, it is spreading out the risk of the stock market. It's spreading out the risk of taxes. It's spreading out the risk of all these different things in your retirement years. Let's have that conversation. Sit down with Sharice and talk through it. 833-368-3680. 833-368-3680 or online, zinniawealth.com. Check out the website. There's a box there. It's a gold box, and it says complimentary retirement consultation. When you click on that, you'll be on your way. All right, so when we talk about retirement, we have to talk about 401ks, because a lot of people are going to go into retirement, and that's going to be their biggest retirement asset. The problem with a 401k is you've not paid taxes on that money, and when you take that money out, you got to pay the taxes, and that could be a problem. So a lot of people are looking at moving money from that 401k place over to a Roth and paying the taxes along the way. It's called a conversion. When do you do it? Should you do it? How much should you do? This is Sean Mulvaney, and he's from Morningstar, and he said he believes there's a sweet spot for doing this between the ages of 66 and 69.
So these 4 years, the world tends to be our oyster. And during these 4 years, we have a high standard deduction. And we now have the senior deduction. Now that's quote unquote temporary for 4 years. We'll see if that is really temporary or not. But regardless, these 4 years tend to be the best Roth conversion years because we don't have required income. We could delay Social Security. We're not managing for premium tax credit. These are the 4 years I think most retirees should be most thinking about Roth conversions.
So I thought about that for a little while. I thought maybe he's saying that because that's where most people do it, because that's when they retire and then they start in on this. But Sharice, would you say that's true? Do you find people that do it earlier, do it later, do it really late? Does it make a difference? Why is this a sweet spot?
Yeah, so this is a very cookie cutter answer, and he's 1,000% wrong. Thousands of percent wrong.
Okay.
Like, I don't care if you work for Morningstar, buddy, but you are 1,000% wrong. Like, how is he even justifying that comment? If you retire at 60, that's when you do it.
Okay.
If you retire at 62 and collect Social Security, that's when you do it. If you are 25 years old and your income is at a certain level, that's when you do it. You can do it at any phase. What he should have said, This is the time it gets sticky and it's a harder decision to do it, is when you turn 73 years old and now you are required to pull money out every year for the rest of your life. And that percentage goes up. It starts at 3.65% and it goes up every year. That's when it's a harder conversation. So I don't know where he gets 66 to 69. He sounds like a kid that just does what most stock jocks do. Just gives you that, oh, that sounds like a great answer. But I will always challenge, because we have people rolling money from IRAs, 401ks into Roth IRAs all the time at all ages. It just depends what your income is. If you are 60 and still working the next couple of years and your income's at a certain threshold and we can roll over your IRAs and 401ks to a Roth IRA before you retire without hitting the next tax bracket, then that's when we do it. Because just so you all know, there are rules out there. Even if you're 59 and a half, you can roll over IRAs and 401ks to a Roth IRA without any penalty, because that is just the rules out there. A lot of people think they have to wait till they're retired or they have to wait till they're 59 and a half. And that is not true. So it's very flexible. A lot of young people now and people close to retirement have shifted gears, and they're not even putting money into a 401k anymore. They're putting it into a Roth 401k because of that. They understand the value, but they still could be rolling their 401ks and IRAs over to a Roth. They just have to pay the taxes when they do that, right? There's no income limit when you're doing these rollovers. So I would say sit down with an income strategist and tax strategist like us who understand the times to roll over and not roll over. It has nothing to do with age. It has to do with your income and your tax brackets and our goals, right? And so we have to talk about all those things.
So I think 66 to 69 is where a lot of people retire. That's probably where a lot of people's income goes down. And so that makes sense in those years in order to do that conversion. Does it make sense to do a conversion even while you're taking RMDs? If you like that first year, you look in there and you go, holy crap, I didn't realize I'm going to have to take this much money. We got to do something. Can you do conversions even in your RMD years in the 70s and even into your 80s?
Yes, you can. And we do the math. We show people, okay, this is your RMD. Does it make sense to be taking your RMD because you are forced to take it, so you don't have a choice, and rolling over a certain percent of your IRA on top of that? And I would say it's like a 50-50. Some people, it depends what your goal is, right? Depends if you think you're going to live another 10 or 20 years. There's so many elements that we have to look at. And it's a 50-50. 50% of the people we see, we show them doing it. It makes sense. The other 50, it just doesn't, based on the math, based on where their income streams are coming. And this is another reason why the sweet spot is not 66 to 69. If you could do it sooner, that would be the sweet spot, because you have Medicare Part B, you have these IRMA penalties that start from age 63. If you start rolling IRAs over to a Roth and your income is over a certain amount, because they take your income plus that IRA rollover to a Roth, they add it all together. If it's over a certain number, now when you turn 65, because they do a 2-year look back, guess what? You're going to be paying not $200 a month for your Part B. You could be paying all the way up to $650 a month. So if we could do it a lot sooner, like when you're 50 or 55 or 60, there's just a lot of math that comes into this, and it's not cookie cutter, but finding out where you stand, depending on your age, makes all the sense to me, so that you don't get hit with those extra penalties. And some people, hey, listen, we don't retire till we're 65, right? And then you want to roll your IRAs over to the Roth. And yes, we sometimes hit that Medicare penalty, that IRMA penalty. But when I do the math, it's still worth it. But if I can save a couple bucks and we start planning earlier, boy, you're a way happier camper.
This is where the conversation starts and kind of develops as you sit down with Charisse. I know that many of you are going to sit down and all you're going to want to talk about is investments and grow my money, Charisse. Yeah, okay. Yeah, that's a really important part of retirement planning. But another part of retirement planning that's also really important is figuring out where you are tax-wise and that you don't run into a big tax problem in your 70s and 80s. That's this conversation, and one you can have with Charisse. Let's sit down and talk about your 401k. And are you a good candidate? Maybe you are, maybe you're not. 833-368-3680, 833-368-3680, or online, it is zinniawealth.com, ZINNIA wealth.com, and there's a gold box there. It says complimentary retirement consultation. You click on that, and you'll be on your way. All right, so Uber, I know you've done an Uber a time or two here, Charisse. Uber has a brand new feature. It says women passengers can now request a women driver, and women drivers can now request women passengers. Uber says it's kind of designed to make women feel more comfortable and in control and safe when it comes to...
What a nice service.
I think I like that because, I put my wife in an Uber and then there's some ugly-looking guy driving an ugly-looking car. I don't know if I want to set her off on that journey at all. But women sometimes can take the back seat when it comes to financial planning. I've heard this over and over and over again, is usually the women are the ones that are doing the monthly bills, and they know everything about the financial situation of the household. And then she turns all the retirement planning stuff, the 401k and the investments, over to him. So then we sit down with a financial planner, and she feels as though she's kind of out of the picture. This is all his thing. And Charisse, you have built a business, a practice with lots of women in it for a purpose, because I know that this kind of gets under your skin. You want to make sure that you're serving this particular area. How do you, if a man comes in all by himself and you know he's married, what do you say to him? And if a woman is sitting there with him and she's not engaged, how do you deal with it? Because this is as important to her as it is to them as a couple.
Yes. If a gentleman walks in, I know they're married and his wife isn't there, I say out. Listen, this takes two, right? No, I don't do that. But we do have serious conversations, right? Because maybe the wife does all the bills and she wants nothing to do with finances. I hear that over and over again, but she is a decision maker. She has to decide. 9 out of 10 households, they decide with you. This is why it's important that they come in, because they need to decide from the very first meeting if they like us or they like that advisor. And some advisors probably, get a little into the math and in the weeds. This is why we've kind of changed our process over the years, because we want it to be more educational. We want everyone from the bookkeeper to the guy who's managing the money to the spouse that's managing the expenses and all that to really understand and come together as one. So normally we'll have that spouse come in on the second appointment, and truly the second appointment's where the magic happens and really where the spouses just really enjoy seeing their future on the screen, and it gives them a little bit more certainty. We make it very simple for everyone to understand, and they really appreciate that. So it's really important to have your spouses in the meetings, at least the second meeting, because they're likely going to be the ones that get left, right? And women live longer, and they need to be here, ground floor, getting to know us. Do they even like us? Does she even want to come on a second appointment? Because women need to be involved. And I know they want to be involved, but a lot of times we have a cop out and we're like, nah, you do it. But it's better to get involved earlier on, because if you're single, because a widow or widower for 10 years, wouldn't you rather know a little bit now, even if it's only a little bit at a time? The digestion can be very slow, and we want it to be slow. We just want we want to build trust. We want you to know who we are. We want you to start understanding little things until maybe one day you have to take over the reins, because it does happen eventually. So I think that's important.
There's a really sad stat in financial planning, and it is that when a man passes away, the woman leaves her financial advisor more than 70% of the time. And it's because she doesn't have a good relationship with that person. And that's because the relationship was built on the man. And that is something that we've talked about here in the past, and something that Charisse and the team at Zinnia Wealth have been fighting. And to try to make sure that both people, both in the couple, are understanding all that's going on. And if it happens that she has to take it all over, it's not going to be so overwhelming. She's in the know, knows what's going on, and feels the support that she needs from her financial planner. Give Charisse a call. Let's talk through it. It is 833-368-3680, 833-368-3680, or online, zinniawealth.com. All right, we're going to have a little fun here at the end here. We got just a few minutes left. About each year, 50 million people visit Disney World. And sometimes when you're there, you feel like all 50 million people are there at the same time. This is comedian Jim Gaffigan, who has brought his kids to Disney a number of times, and he's just kind of having a realization about it right now.
And I know there's a lot of people that love Disney, and I just want them to know they're wrong. And I should know. I've been multiple times, and I realize Disney is like, for me, it's like jalapenos. I never learn. I always think I can handle it, and then a couple hours later, I wish I was dead.
That is hilarious.
As
that
parents,
is so true.
We have all experienced what Jim is going through there. All right, because he keeps making the same mistake over and over again. He'll go, okay, let's go to Disney again. All right.
And then you get in those lines for 2 hours. You're like, didn't we learn this lesson last time?
All right.
Yes, we did.
Here's my financial spin on that. Charisse, have you seen people that make the same mistake over and over and over again? What would that be? Is there something that people will do? I mean, is it like freak out because of the market and they're calling you all the time? Or what is it that you see happening over and over again?
I think the one thing I see most is when markets are volatile. People stop drawing income from portfolios.
They cut back.
Not our clients, but we'll see a big slew of people coming in, new people. They're like, we want to stop the income. We want these accounts to go back up as we move them over to you, Charisse. And I'm like, well, we don't want to do that because now we're changing, your lifestyle, and you shouldn't be invested based on how you're pulling money, where you're pulling money based on lifestyle. We don't want to change that. So we just need to button up the plan, continue the income, but just change where the asset is invested. So we're just going to put it in a different buckets so that you can still take income. And so I think a lot of people they worry because their money was in the stock market and they watched it lose 10, 20, maybe 30%. That's a little too late at that point, right? To be moving money around, but people still do it. The biggest mistake is we get emotional because we know we need our money and we sell at the bottom. Okay, if we make some moves at a 10% loss, maybe 15%, but when you start to get heavier and heavier, don't let it get that deep, because then it's like, do we sell at 30%? And the answer is no. I mean, goodness gracious. How long is that going to take you to get back to even? So there are strategies out there, but again, we want to be very cautious how we invest our money, how we pull our money out, and when we sell it. I know we're emotionally tethered to the dollar, and when you need your money, you need it. And I've just seen so many people sell at the wrong time.
And we're right in the middle of that right now. People are freaking out right now. Yeah.
And there's no reason to freak out right now, by the way. There's no reason right now. This is a typical correction. Lots of noise out there, which is causing people to be even more worried. But is this short-term noise or long-term noise? And so you should be talking to your advisors about this. Like, what's our plan? Where are my dollars being pulled from? Are they being pulled from this loss I just took or my safe money strategies? And if like, oh, well, you don't have safe money strategies, and then Houston, you have a problem, and your bonds are not safe money strategies, right? Because when markets go down, those lose too. So we just want to be cautious about where we pull our money from and how we manage our money in the future. And so I just want to be the voice of reason right now as noise is hitting your TVs, the radio shows. If you're nervous, that means you don't know your plan.
Or too much risk,
Or maybe you saw, you've got $1 million and now you're at 900, then, you have too much risk. And if you're concerned about it, that's when you certainly need to come in and see us, right? And we can at least start talking to you about it.
Couldn't have said it better. Here is the number. Here's the website, 833-368-3680. For an appointment with Charisse, there's no cost or obligation there. Let's just get your concerns out on the table and see if we can help. 833-368-3680, or the website is ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that, and you'll be on your way. Charisse, that is all the time that we have on this one. I'll give you the last word.
All righty. Well, don't forget, you can hit the rewind button and go to our podcasts on iTunes, Spotify, YouTube, your Apple phone, you name it. We are there. And as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.